Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically the financial statement and tax return analysis. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Financial statements, tax returns, and how creditors analyze the same. Creditors expect to review typical financial information such as an income statement, balance sheet, reconciliation of equity, cash flow statement, and any applicable notes to financial statements. Other documentation will include current personal financial statements for individual guarantors, along with copies of business and individual federal and state income tax filings for all obligated legal entities and individuals. Supplemental statements such as detailed accounts receivable and accounts payable reports and even inventory reports may be needed. At a loan origination, it is customary to request the last fiscal 3-year end business financial statements and business and individual federal and state tax returns. These financial reports will need to be signed and dated by the obligors, often with a stamp that says the signature affirms the data therein are true and correct. A comprehensive analysis will measure the business's operating performance from the income statement, as well as how the assets and liabilities were managed from the balance sheet. The cash flow analysis will be critical because it determines the debtor's ability to repay debt now and the prospect of future repayment. A deep dive credit repayment analysis. A determination will be made to identify recurring versus non-recurring cash flow. A thorough analysis will help identify other sources of repayment for the creditor if need be. Documentation supporting valuations for commercial real estate would consist of operating statements for each operating entity, plus tax return filings and current rent rolls. For cash deposits, bank statements can be obtained, and for public stocks, there can be online quotes. Individual credit reports will be used to verify information on individual guarantor personal financial statements. Pending or actual legal action or litigation must also be disclosed, together with the potential outcome and impact on the business. Furthermore, with 3 years' worth of financial statements and tax returns, a credit analyst will prepare a spreadsheet analysis showing the year-over-year trend analysis and how the performance matches up with industry peers. A ratio analysis will determine the level and trend of profitability, operational efficiency, leverage financing, and liquidity. Weight will be applied to the financial statements with support coming from the tax returns. The analyst will be able to understand the differences between the results of the financial statements and tax returns, and financial statement spreads will be common-sized, where each line item on an income statement, for example, is expressed as a percentage of the value for sales. This will show performance over several periods, be it quarters or years, and can be used to compare to peers and competitors in the same industry. Typical observations of credit analysis. Financial analysis over time will often identify weaknesses which may affect the internally assigned credit risk rating. Current assets such as accounts receivable may be experiencing a slowdown in the collection period due to account debtors failing to pay on time, or from the easing of collection periods beyond the original terms, or even a loosening of credit standards. Inventory can also experience increasing levels in both the dollar amount or as a percentage of assets. This can be problematic if inventory isn't selling as expected, as the accounts payable due the trade suppliers still needs to be paid on time too. Perhaps the inventory levels or materials are too excessive for certain products due to overbuying or it's becoming obsolete. Hence, even liquidity may suffer too to maintain profits. A company may also use secondary financing to finance operations as evidenced by junior lien holders. This is likely an indication that the debtor is now unable to obtain conventional financing. The level of long-term debt may also increase, indicating an increasing reliance on recurring cash flow over the long term of repayment or for repayment. Analysts will also measure the costs and expenses on the income statement to determine if the cost of goods sold is increasing and if other overhead expenses are increasing as a percentage of sales. So why is all this important to you? If you don't know, ask, share, and fill in the gaps for mutual understanding. Does it come as any surprise to you that the creditor does such an in-depth credit analysis of your financial statements and tax returns? Creditors really do attempt to understand the root causes for your financial performance or underperformance and can readily determine the prospect for repayment. Creditors are required to risk rate or assign the appropriate risk grade or loan grade to match the credit risk, whether or not you're going to pay on time, for each of your loans. You should find out what the current credit grade is and ask to be notified when that grade changes. It helps to know what the creditor is possibly thinking when economic conditions have deteriorated and are negatively impacting businesses like yours. The creditor should not be the only one who understands the why behind the numbers on the financial statements. You too probably already know exactly why performance is lacking, and you know what needs to be done to remediate or correct the problems. But if there's any doubt as to what is negatively impacting your financial performance, rest assured the creditor is 99% confident of what's happening. So you may need to catch up. You need to get on the same page. He may not fully appreciate the reasons why like you do, so be sure to fill in any gaps to have a mutual understanding and ask questions of the creditor and listen to what he says and see if you can get on the same page. Again, you own at least half this relationship anyway, right? Thank you for joining us. Today we have covered the Creditor Tool Financial Statement and Tax Return Analysis as debtors prepare to propose their own repayment solutions. And we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you find today's episode helpful, please subscribe for notifications of future podcasts, as your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.